For decades, beating the stock market has been the ultimate challenge, right? It's chaotic, it's unpredictable, it's driven by everything from global economics to just plain human emotion. But what if we could teach an AI to see patterns that we can't? Well, today we are diving into a really fascinating study that pits three different models against each other to answer one simple question. Can modern AI finally crack the code of the stock market? All right, so here's what we've got on tap. First, we'll set the stage and talk about why the market is just such a tough beast to tame. Then it is time for the main event, a battle between our three forecasting contenders. After that, we're going to crown a winner, dig into the secrets of its success, and we'll even get to peek inside its digital mind. And finally, we'll wrap up by looking at what this all means for the future, for the entire playbook of financial forecasting. So, to really get why AI is even in the conversation here, we have to appreciate the core problem. Why is predicting the market so notoriously difficult? Well, the answer is that it's not some simple predictable machine. It's the exact opposite. The thing is, financial data is just incredibly volatile and what we call nonlinear. You see, a lot of traditional models, they kind of assume that the patterns of the past will just repeat themselves. But come on, anyone who watches the market knows that's almost never the case. It's this really complex dance of hard numbers, political bombshells, and the collective psychology of millions of people. And that's exactly where older models just hit a wall.
So to tackle this massive challenge, the researchers basically set up a showdown, a contest between three totally different approaches to forecasting. Let's meet our contenders.
In the first corner, we have ARIMA. Now, you can think of ARIMA as the old-school statistician. It's a classic. It's mathematically sound, and it's really great at finding these nice, straight, linear patterns in past data. The upside is it's easy to understand what it's doing. But its big weakness? It assumes the rules of the game never change. And that is a very risky bet in today's markets. Next up, we've got the LSTM, which stands for Long Short-Term Memory Network. This one is our memory mastermind. It's a seriously powerful deep learning model built specifically for data that unfolds over time. And its superpower? Well, it's all about remembering important events from way in the past while conveniently forgetting all the irrelevant noise. That's absolutely crucial for understanding those big, long-term market trends. And our third contender is the 1D CNN, or a convolutional neural network. Now, this is cool. You might know CNNs from things like image recognition, telling cats from dogs in photos. But here, it's been cleverly adapted to be an agile pattern spotter for financial data. So instead of looking for edges in a picture, it's scanning for these short-term, localized signals, like a sudden spike in volatility or a quick shift in momentum. So, to put it simply, each model is bringing a completely different strategy to the fight. You've got ARIMA looking for those straight lines. You've got LSTM trying to remember the entire history of the market. And then you have the CNN, which is laser-focused on spotting these small, recent, but super impactful patterns. Three totally different playbooks for the same chaotic game. So, the moment of truth. How did they actually do? The researchers put all three models to the test on over a decade of S&P 500 data. We're talking from 2010 all the way to 2023. And their job was to predict the next day's price move. And let me tell you, the results were surprisingly clear. And wow, there is a clear winner here. The CNN model comes out on top, and by a pretty healthy margin. It had the lowest error rate, or RMSE, which basically means its predictions were the closest to what actually happened. But maybe even more important is its directional accuracy. Did it correctly guess if the market would go up or down? It got it right almost 59% of the time. That's way, way better than a coin flip and noticeably better than its competitors. And when you see it visually like this, the gap is just huge. That bar for the CNN's error rate is just so much lower than the LSTM and especially the old-school ARIMA model. So this wasn't just a small victory. In terms of accuracy, it was a really decisive win. Okay, so this brings us to the big question. What was the CNN secret? Accuracy is one thing, but this study revealed a few other advantages that really make it a true champion. Turns out its secret weapon wasn't just what it predicted, but how it did it. Okay, get this. On average, it took the CNN model just 9 minutes to train. 9. For a complex model like an LSTM, that same process can take way, way longer, sometimes hours. This incredible speed means a system built on a CNN could be retrained super fast, letting it adapt to new market craziness almost in real time. So its success really boils down to this killer combo of three things. First, its whole design is just perfect for spotting those short-term, local patterns that are all over financial data. Second, its structure lets it process things in parallel, which makes it lightning fast. And third, it turned out to be incredibly stable and less likely to overfit, where a model starts seeing patterns in random noise. It's accurate, fast, and reliable. But here is where things get really, really cool. One of the biggest knocks on AI is that it's a black box. We know it works, but we don't always know how. Well, the researchers use some pretty advanced techniques to actually peer inside the CNN's brain. In other words, when this AI makes a prediction, what specific pieces of information is it paying the most attention to? And you know what? The answer is surprisingly intuitive. Using this clever technique that helps explain an AI's thinking, they found the model focused most on the exact same things a human trader would. We're talking very recent price moves, current market volatility, momentum indicators like the RSI, and short-term moving averages. It wasn't looking for some secret, hidden code. It was learning to use tried-and-true financial ideas, just with incredible digital precision. And this quote from the study just nails it. They used another tool that basically creates a heat map of the AI's focus, and they saw its attention just light up around the most recent trading days and anytime there was a big spike in volatility. It's focusing exactly where the action is, which is exactly what a smart human analyst would do. So what's the big picture here? What does all of this actually mean for the future? Well, having a model that's not just accurate, but also fast and transparent, that's a potential game changer for the world of finance.
When you put it all together, what we have is a new blueprint for what a truly effective financial AI should look like. It's not just about getting the right answer anymore. It has to be accurate at spotting those really subtle, short-term patterns. It's got to be fast enough for real-world trading. It absolutely must be transparent so we can trust it and regulators can sign off on it. And it needs to be stable and reliable run after run. This study shows the 1D CNN pretty much checks all 4 of those boxes.
And that leaves us with this one final fascinating thought. We've just seen a model that can predict the market with pretty impressive accuracy, do it super fast, and then turn around and tell us why it made its decision. If we've started to solve that whole black box problem while actually improving performance, what new doors does that open up for finance? The playbook is officially being rewritten.